Well, geopolitical tensions remained front and centre last week, with traders continuing to keep a very close eye on developments in the Middle East. But Treasuries are telling a story of their own, with the long end continuing to violently sell off and the curve steepening pretty aggressively. Combine those two, and you had equities notching their worst week in just over a month on Wall Street, though the FX market largely trod water over the last 5 or 6 trading days. Another interesting week awaits this week, a busy old data docket on the slate, plus a big week of tech earnings as Q3 reporting season continues, and decisions from the Bank of Canada and the European Central Bank in the mix as well. Plenty to discuss on the trade-off this week, so without further ado, let's get into the show. So lots going on in the markets at the moment, and plenty of moving parts in the mix too, with the geopolitical situation, rising treasury yields, tightening financial conditions, and some interesting policy decisions looming on the horizon. Joining me as always to try and make sense of what's going on, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, very good afternoon to you, mates. I guess we should probably leave this weekend's sporting results to one side, given the cricket, the rugby, and, well, in your case, the football as well.
Yeah, and your lucky scraped result as well. Yeah, we'll leave the sports behind today, and let's concentrate on what's coming up this week. There's a lot going on. We've got a lot of data, central banks, all sorts of things happening. So it's going to be a busy one, hopefully exciting one.
Yes, absolutely. Busy and exciting, I think, are the two sort of orders of the day at the moment. And rested and refreshed after a week off, and hopefully ready to hit the ground running with some vol and a bit of excitement in the markets this week as well.
Yeah, very much so. And I can't wait to get stuck into it. We've got a few trades on the burner at the moment. Everyone's obviously watching dollar yen at 150, what it's going to do up there. So, looking forward to it, mate.
Indeed. Well, you've said twice now that you can't wait to get stuck in. So I won't prolong your agony any longer.
Let's go.
Yeah, let's go. Come on, topical thunder. Let's go. 2:10 on a Monday afternoon, and that's as energetic as I'm going to get this week. I think it's all downhill from here.
You need to lie down. Go and have a lie down after this.
You can do the rest of the show. I'll go and have a kip. Right. I want to talk about the Fed, first of all. The FOMC are in their pre-meeting blackout period now, ahead of their next policy decision on the 1st of November. So that's all we're going to get in terms of nudges, winks, and guidance for the next policy decision from the committee. It is worth noting, actually, we do have some remarks scheduled from Chair Powell on the diary this week. Wednesday evening, I think he's due to speak, but we're in the blackout period, so there's not going to be any comments on the policy outlook there. We did, though, get some comments from Jay Powell last week on the policy outlook, and he was just the latest Fed official to lean into the idea that, the tightening cycle is pretty much done and dusted, and that the market is doing the Fed's job for them, noting that what he called persistent moves in financial conditions can impact monetary policy decisions. Now, this, of course, follows what's becoming a bit of a script and a bit of a line to take for FOMC members. We heard the same from Collins, from Bowman, from Daly, from Jefferson, and from Logan in recent weeks. So, it's by no means an accident when all Fed officials are singing from this sort of hymn sheet. And I think that's now firmly an indication that the Fed are not going to raise rates in November, and actually that they are probably done in terms of hikes. And actually the market is pretty much on board with that view, pricing no chance of a move at the meeting next week, and just 9 basis points worth of tightening by the beginning of next year, by the meeting in January 2024. What is still interesting, I'm keen to get your thoughts on this, Ryan, is this divergence we got in terms of cuts, because the Fed have been very clear, higher for longer is still the stance. Policy needs to stay in restrictive territory for some time. But the market is still pricing in 3 cuts in the 12 months from January of 2024. And in my view, I think it's very tough to see the Fed endorsing that stance and leaning in to that market pricing. I think higher for longer remains the policy mantra. So although you could argue that if the Fed are done, there's no bullish dollar impulse coming from the policy side of things, I would say actually there could still be one, because you've got a lot of cuts in the curve that still need to be priced out. And of course, on a relative basis, as inflation continues to fade next year, if the Fed remain on hold, if the Fed leave rates where they are, on a relative basis, policy will continue to tighten. So although hiking may be done, I think the policy story in terms of a dollar driver is still far from over.
Yeah, very much so. And I think you're right. I mean, I'm thankful for this period because it's just been a complete flood of central bank speakers. And now we have this nice quiet period where they all shut up. The ECB have all shut up and the Fed have all shut up. So, I'm enjoying the peace and quiet. But you're right. I mean, Powell did his usual game, playing both sides of the coin, ready to do more if needed. But, we're assessing things as we go. He touched on yield just briefly, just giving a little tap to the markets to say we're watching by saying we're attentive to what's happening in bond markets, although we don't see any problems just yet. So he's always just making sure that the market knows they've got an eye on everything. We're seeing this shift, particularly from the banks and the institutions. Everyone's knocked out November as a possible hike date. A lot of that shifting to December by a few banks. But it's still, like you say, 9 pips of tightening by January. It's not a lot. So the market really on board with this pause that we've got. And it's going to take the data that's going to change that. And inflation has, it's still sticky, but we've ended that run in the CPI data of it moving higher, although the headline was unchanged. So that's a pause in itself. We get the GDP, which I think is going to be really interesting this week. Some big numbers due there. But overall, we've had Harker out at least 20 times. I think he's got a competition with Bostic and how many times they can come out speaking between FOMCs. I'm not sure who's winning, but he might be shading it. So we know the thoughts, or we know the doves, we know the hawks. Mester still thinks there's a hike to come at some point. So it's all in the mix, but it's all about the data, and inflation is the key metric. The rest, jobs, housing, all the others, it's just going to depend on whether we see a deterioration or even them heating up again.
Absolutely. We must remain as data dependent in our stance as policymakers do in theirs, I suppose. I was going to talk about GDP, but I don't want to steal your thunder, mate. I know you're going to go on to some of the data because it is a very busy week, isn't it?
Yeah, very much so. And things are really hotting up this week. A bit of a quiet week on the data front last week. We start on Tuesday, which is when you'll be seeing this show. We will have the start of the flash PMIs from around the globe. Obviously, we get Europe, Asia, and then into the US day. So we'll be keeping a close eye on that for the new month to see how things are turning out. Are we going to see a bit more positivity? We saw some of the numbers, just starting to tick back higher again, or at least stop falling down in a lot of aspects. So going to see if that continues, maybe a slight bit of improvement, a dead cat bounce. Wednesday, we get Australian CPI, which, could be a hike hold decider for that balance at the RBA. Most measures of CPI, they're expected just to fall marginally, but if there's an upside surprise, we know that the RBA, every meeting for the last few have been, we talked about hikes but decided to hold type things. Obviously, we've got the new governor there, Bullock, who's sounded a bit more hawkish of late as well, or in comparison to Lowe. So we need to see what happens with those folks over there. Bank of Canada on Wednesday, we were talking about this a lot last week. It's been a bit of a twist since our show last week because a more hawkish Governor Macklem has given a huge sigh of release last week on the softer CPI numbers, and that's really shown how nervous these central bankers are, talking more hawkishly on the back of a couple of inflation prints. Then we get another one that goes the other way, and all of a sudden the market wipes out the expectations for a hike. His comments really opened the door to that hike, but perhaps it's been slammed shut again. We get to hear from them directly this month, or Macklem directly, because it's a monetary policy report meeting, so a press conference. Sorry?
Oh, good. I can't wait.
Yeah. Well, it's always good to hear from those guys over there. It's worth putting your feet up and falling asleep for 20 minutes. But we'll be up and watching it and trading it, as no doubt. So that's coming on Wednesday. Thursday, obviously, have the ECB, which you're going to talk about shortly, Michael. And, you're going to tell us exactly what Lagarde's going to say, I'm sure. And then, as mentioned, we get that the first numbers of Q3 GDP from the US. And a whopping 4.2% is expected. So there's going to be a lot of anticipation for this release, and hopefully there's going to be some decent volatility around it, if there's a big variation either side. Again, for that one, I think we're all going to have to be bond traders first and foremost for those numbers dropping. Friday, we get the latest US PCE numbers. These are for September, which is part of Q3. So I'm never too sure whether these are included in the Q3 numbers or not. But when they come a day after the GDP report, sometimes they don't tend to have much of an impact. Still, we know what's happening with CPI from the or inflation from the CPI data we got before, so it should be pretty similar. PC is expected to come in at 3.4, down a pip from 3.5. The core 3.7 from 3.9. So a lot of data, a lot of noise that should be coming, and hopefully some decent market moves.
Yes, absolutely. There is a hell of a lot going on. Just to kind of take that in reverse order, I guess. Yes, you can, if you're boring enough to want to do it, you can back out the September PCE and income and spending figures from the Q3 GDP data. Why you'd want to, I don't really know, because
I'll leave it to you then.
Well, I need to go and find an intern to go and do it for me.
You've made a promise now. You've got to deliver.
But yes, you are able to do it. So I think the vol around that could be a little bit more limited. The GDP number is, well, it should blow the doors off. I do wonder whether it's going to be a little bit of a kind of buy the rumor, sell the fact thing where, if we get a print, I don't know, so consensus is 4.2, let's say we get something at 3.9. If we do see a bit of dollar downside, equity upside, a bit of a rally in treasuries on that, it's still 4% for goodness sake. It's a scintillating pace of growth for an economy which is very, very late in the cycle. So I don't think we should have too much to worry about there. I think the BoC is pretty much nailed onto hold after the inflation data last week. It pains me to say it, but I think the Aussie inflation figures could be the biggest event of the week, given the market is still rather undecided around where the RBA go next.
Yeah, that's a big call. So you're getting up for that one, are you?
No.
What time? I think it's about 3 a.m. or something. So
I don't even know what time it is. All I can tell you is it's too early.
You make these promises, you make these big calls, and you're not going to be there to see it and tell us what happened. But it could be. I mean, the RBA. I won't go so far as to say they're one of the worst central banks out there, but they are. They weren't supposed to be hiking until 2024, if you remember, and now they're probably going to be hiking again if there's hot inflation, and maybe they'll start cutting in 2024. But yeah, it's definitely going to be a big one for the Aussie. Probably want to be looking at the crosses more than what's happening against the dollar, because that's a bit of a one-sided trade at the moment.
Yeah.
But yeah, there's lots to look at and hopefully lots to trade.
Fingers crossed. Right. Well, one thing I am going to be around for, excuse me, and at my desk for is, sadly, the next ECB decision. I would much rather not be at my desk for that, I must admit. What do we expect from the ECB this week? I mean, in short, not a lot, to be honest. I think this is very much a kind of incremental non-event meeting between what was, at the time, a surprise hike at the September meeting and the next decision in December, when we'll get the latest staff macroeconomic projections. We'll also have had the Q3 GDP print. We'll have had another month or two worth of inflation data as well. So I don't think anyone is really expecting the ECB to do particularly much this time around. The deposit rate should remain at a record high 4%. The guidance will still be along the lines of, needing to keep rates sufficiently high for sufficiently long, and that the data will continue to guide policymakers in terms of the duration of time that rates spend at their terminal level. I mean, speaking of that data, there are some positive signs on inflation, both headline and core CPI coming back below that 5% mark in September. But then when you look at the growth side of things, the PMIs, and I know we have the latest PMI data coming out on, is it tomorrow or is it Wednesday? Tomorrow.
Yeah, tomorrow.
Tomorrow. There we go. So that will be just before the next ECB decision, but again, expected to remain below 50 across all three measures. And I think what's likely to be of more concern to policymakers is actually the issues we've got going on in the Middle East, the geopolitical tensions there. that could really hit the Eurozone quite hard if we were to see any escalation, given, as we all know, and as has been very, very well documented, how big of an energy importer the Eurozone remains. I mean, there's some discussion and some debate on the sell side over whether the ECB will discuss some of the slightly more boring and nerdy aspects of their policy toolkit, mainly the remuneration on reserve balances, and also whether they will wrap up the reinvestment of PEP purchases, Pandemic Emergency Purchase Program, whether they'll wrap up those reinvestments a little bit earlier than currently planned, which is the end of 2024. I think it's unlikely we get any conclusions on that, first of all, and also I think it's unlikely they now bring forward the end of that, given that if you look at what's going on in the bond market, we're seeing a pretty violent sell-off across developed markets, and also that's driving the BTP Bund spread back above 200 basis points. So the ECB will want to tread pretty carefully there. And I think that leads us nicely to Lagarde's press conference. The perma-tanned one will probably remain pretty cautious there, not really wanting to pre-commit to anything. And it's tough to see a hawkish surprise. It's tough to see a dovish surprise. In fact, it's tough to see anything interesting at all from this one. And I don't want to become a hostage to fortune here, but I can't help but think the euro might just turn a blind eye to all this.
Yeah, well, hopefully that's a kiss of death, and we get some decent volatility, and then we'll create an indicator out of that one, Michael. But yeah, it's going to be potentially a lesser impact meeting because rate hikes aren't really on the table, or rate moves aren't on the table. They're going to stay on pause. There's no reason why they come in with another hike, if just on inflation. We know it's still sticky, so there are some who would still keep one in the pipeline, but for now, I think they're done on that. I think, the conversation, anything hawkish sounding is going to be regarding the PEPP and QE in general. We've also got the discussion on the deposits, that the banks hold. They've got all this tiering and these different rates, and maybe they can tinker something there or indicate tinkering something there. But it's all small fry stuff in terms, measuring that against rate hikes. Will they do something this month? That'll be a bit of a shock if they do. We know the conversation has been growing. This was
a bit of a shock.
Yeah, it will be a bit of a shock if they actually do something. I'm using the English term. We don't like to scale a grandeur and everything like that. We keep our feet on the ground. So yeah, it'll be a bit of a shock if they actually act on PEPP. So I think at most we should expect that conversations have begun, and that the formulation of the next data, because I love punting between forecast meetings, will define whether they actually act. I think if they're going to indicate anything, they'll probably pencil it in for the early part of 2024 when they may make those changes. Gives everyone a lot of time to get through the end of the year and then get planning for that. So yeah, we don't want it to be a boring one, but it's got the potential to be a boring one. As for the euro and what that does, you mentioned yields. That's what we've got to watch again there. I'm not too concerned about these Bund spreads, BTP Bund, because there's some things happening in Italy, their finances, deficits and whatnot that are causing yields to rise. But if you look around the bondscape in the Eurozone, Italy is the only country that has 2-year bonds, which are a reflection of the shorter term rate picture, at 4%. Everyone else is, 3.5, 3.2, 3.1. And that's a bit behind the higher for longer message that the ECB have compared to the Fed, if you look at 2 years over there, sailing right around the current rate level. So maybe there's a bit of something there for Lagarde to be a bit hawkish about, just to bring those expectations, the higher for longer message, into the market, and maybe that pushes yields a bit higher.
Very much an evergreen comment there, Ryan. There's things going on in Italy. I think that's probably we should just stick.
Covers all bases. You see, I can sound right on everything.
Absolutely, things that no one can even try to explain. And I say anymore, I'll get in trouble now with our Italian marketing chap. So I'll zip my mouth shut. We'll move on to the US housing market before I get a slap on the wrist.
Yeah, well, there's things happening there as well, mate. So there we go. I don't need to say anything more. Move on to the next one. But no, I'm starting to see some growing signs of stress coming into the US housing market. some of the private data points are starting to wave a few yellow flags, not quite red flags, but yellow flags at the moment. The weekly MBA data I keep an eye on closely. It's seeing more and more negative application numbers more often. The purchase index is at the lowest since the early 90s. The refinancing index is at the lowest since the early 2000s. The NHAB, National Association of Home Builders index, is slipping back towards its pandemic lows. But the main housing numbers, the data points, are only now maybe tentatively starting to see this weakness that we're seeing in the private data coming through. Last week's September building permit beat expectations but fell versus August. Starts, however, missed expectations but went up over last month. So, give with one, take with the other. This sector is being almost as stubborn as the jobs market. But as I say, I'm getting the feeling we might be nearing a bit of a cliff edge. Rate hikes are going to start biting hard, and in the housing sector, that's where it often bites the hardest. Because not many people are likely to move home and out of a 2-3% mortgage into a 7-8% mortgage. So the majority of activity is going to come through new owners or those whose pay has increased with inflation. So if these trends with the private data continue, we're going to see that filtering more into the main data. And if housing turns quickly, expect that slump to spread to other sectors pretty quickly as well. I think a soft landing in housing may be about to get a bit bumpier.
Well, that's nice and optimistic, mate, isn't it?
I call it how I see it, mate. This forms how I trade. I'll keep a close eye on this. I
thought I was meant to be the pessimistic one on this show.
That's you're a whole different level of pessimism, mate. Believe me.
I do agree with you. I was actually chatting with one of the young lads in the office who started recently today about the housing market, and I think the problems on either side of the Atlantic, as you rightly alluded to, are different. I think here it's becoming an affordability problem. Whereby people can't afford the doubling or the tripling in the interest rate and interest payments on the mortgages because we fix for a relatively short period of time. Whereas, as you say, in the US, I think, and that will just following on from that should result in prices coming lower. Whereas in the US, it's a totally different problem because if you've got a 30-year fix at 3.5%, you are clinging on to that like your life depends on it, and you are not looking to move house anytime soon. So I think there's a risk, as you say, that the US housing market just seizes up and just activity completely dies off because you need that influx of new buyers in order to keep the market going. And that's not a sustainable way to operate the housing market. So, I think that is a real risk. And it's going to be interesting to see how, or indeed if, there is a policy response to that, particularly because we're 12 months from an election.
Yeah, very much so. That could be, that's a very good point that we've got the election next year. So, keeping people in houses and keeping the value there as well is going to be important. But just to be optimistic, let's say, it's not a linear straight line that people are going to stay in their house just because they've got a cheap mortgage. If you've been in your house 10, 20 years, you've probably got a decent equity build up in the value of your house. So that can offset some of the impact from moving and higher mortgage rates. So it's not always as straightforward as we make out, but the market tends to look at these things in negative terms. So if we do start to see the whole sector suddenly heading lower, that's going to, as I say, raise some decent flags.
Oh, there we go. He's happy again. Right. Before we move on, I want to do Topical Thunder 5, Topical Thunder 4.5. I just want to mention earnings very, very quickly. There's so much going on. We haven't actually had a chance to mention it. So before Kyriakos tries to kill me because I've taken too much time, we've had about a fifth of the S&P 500 report already. As always, everyone is just massaging their numbers lower and massaging the guidance lower and the expectations lower, and then coming in and beating those expectations. I think something like 75% of the reports that we've seen so far have beaten consensus expectations, which is pretty much in line with what we see every year. This week is when earnings really get going. 160 of the 500 firms in the S&P reporting this week. It's all about the big tech names, Microsoft and Google, aka Alphabet, on Tuesday after the close, Meta and IBM after the close on Wednesday, and then Amazon and Intel after the close on Thursday. Why is this important? Well, if you think about what's been underpinning the market for so much of the year, it has been the Magnificent Seven. It has been those big tech names. If we start to see earnings beginning to soften there, and I know you're going to talk about the S&P a little bit later on, Ryan, so I won't go into that in too much detail, but if we do start to see earnings soften there, then perhaps that could be the next source of downside for the US equity space. But important to mention that given how busy a week it is. I think it is actually the busiest week of Q3 reporting season this week.
Well, you've got a lot on your plate this week, haven't you, mate? Aussie CPI, how many? 106, was it? Companies you're going to be keeping right? Oh, well, you've got to keep us informed on every single one of them. We want detailed analysis this time next week, mate.
Absolutely, mate. Pencil in 8 hours for the show next week and we'll be right on it. Right, let's move on to That's a Setup. Right, I want to talk about bonds to start things off this week. I mean, Treasuries are really the only thing worth watching at the moment, I would argue. Certainly one of the key drivers of what we're seeing in the equity space and also across the board. And what continues to catch the eye is this really rampant sell-off that we continue to see at the long end of the curve. The 10 and the 30-year Treasury yield, the nominal yield here, having their biggest weekly rises, their worst weeks effectively, since the middle of 2022 last week, both up around about 30 basis points on the week. And there's really no sign of that slowing down either. As Ryan said earlier, we hit 5% this morning, Monday morning, for the first time since 2007 on the 10-year, and it looks like we're going to continue heading higher. The net effect of this, and particularly with the front end of the curve happy sitting around 5.1, 5.2%, with the market buying into the idea that the Fed are done and dusted in terms of hiking, is a huge bear steepening of the yield curve. The 2-10 spread is set for its biggest 1 month rise since March. That was, of course, when US regional banks were blowing up and the bond market had a lot of dysfunction going on. And I think this is a little bit more concerning for me than the inversion itself, because as the chart shows, recession warning bells and alarm bells really start to ring when the curve re-steepens and when it steepens back above zero, rather than necessarily when the curve first inverts. Now, I've got to say, there's not really a lot in the data to indicate that the US is on the verge of a slowdown. And, we're looking at 4% GDP growth in the second quarter. And a lot of this move at the long end is being driven by something called the term premium, rising term premium, which we certainly don't have time to get into now. But what I would like to point out is just that the momentum behind this move doesn't seem to show any signs of slowing just yet. And given the sort of predictive power, if you like, of Mystic Meg, the 2-10 spread, I think it would be remiss and folly not to flag up exactly what's going on there. And of course, the other thing to bear in mind is a little birdie tells me that before too long, you may well be able to take advantage of this sort of thing with Pepperstone ourselves. So the bond market getting very, very interesting indeed. And I think we made the point last week or the week before, Ryan, if you're not watching 10s, what are you doing? And that still stands, I think.
Yeah, very much so. And things like the curves can be quite complex for a lot of people. So if you want to take things in simple terms, you can stick to just what yields are doing. Now, I don't know. There's different things afoot here, because we're seeing these moves in bonds, but it's not wholly reflective across other assets. Maybe perhaps stocks. The FX is really sitting back and doing nothing on this, which is unusual, because when you get these sorts of moves, then you get that FX impact. Because it's not just a US story, it's a global yield story. I mean, today we've had US yields knocking up through that 5% mark briefly. All yields across the board are rising. So, not every economy is going to go through the same yield curve, but every moment everything looks a bit similar. The bigger impact I think that's coming from this is going to be the further issuance from the US. I think they're set to almost double what they were going to do in Q4 to previous expectations. And while yields are moving higher, that's going to put additional stress on the market because we've already seen demand dropping. And if demand drops further, it's going to make it harder for the US, to get all these sales on the table, and also the premium demanded is going to go higher. So it's almost like a false economy in some of these moves in the curve because it's coming because of what's happening in these auctions and other things. So I wouldn't say it's as clear a picture in terms of fundamentals and economics, what 210 signal and how we move from those inversion, into recessions and whatnot. Because as you can see, it's quite a steep one there on the chart. But yeah, I think you've got to take it in parts. See how the US does with these auctions first, then see how the economy does after that, and then you can make a judgment in terms of what these yield means actually mean for the economy.
Yes. The other thing, just lastly on bonds, is we do have the quarterly refunding announcement next Monday, I believe it is. And I was reading a few notes this morning that the sizes of auctions across the curve are likely to be upped pretty substantially. And of course, Biden now wants another $100 billion in military aid as well to the Middle East and to the Ukraine. So, what's $100 billion when you're already issuing a shed load of debt?
Yeah, just pop down to the bottom of the garden to the magic money tree and pluck a few more leaves off.
Give it a shake. Right. Let's have a look at that shiny thing, the yellow metal, because you've had your felt tip pen out with this one, haven't you?
Yeah, you complaining about my art skills here, but it does its job. That's all I care about. Gold, it remains the Middle East, risk trade of choice, if you like. And once again, we saw a late rally into the end of the UK-EU week last week on Friday, just before some profit taking kicked in as the US closed up. The same happened in bonds as well, US bonds, which found a bit of a bid in the latter part of the day after another test and failure at 5%. I think this is still traders late in the week, just reducing positions, risk positions, maybe putting on a bit of protection just in case of any negative news over the weekend. So I'm not reading too much in, but that's the second Friday in a row now we've seen these similar moves. It can get volatile into a weekend. You get a big headline, so I think that's why gold has been more of a risk play throughout this whole episode. Now, we've seen in the early October rally continuing aggressively, and this is where it's time for top pickers to be really careful. What I really want to show you on this chart is how the rallies have acted. Each time the price hit a tech level, these are just my tech levels I have on the chart, it's stopped, but it's only pulled back by small margins. And this is a clear signal if you want to look at price action and trying to pick those tops, that it's a dangerous game. Yes, you can trust some of the levels, but if you're going to go against the trend, you need to be nimble in taking profits and then protecting the rest of your trade. So right now, there's no telling how high this wants to go, but until we start to see a firmer top put in, it's a very low risk we're all trying to fight these moves. What you want to see if you want to try picking a top is the price behaving how I've highlighted in that yellow box. That's when you get a high made, then a secondary or even a third test over a reasonable period of time. That's the price action that determines that the price has maybe gone as far as it is going to go for now, which means if you want to short it, you can have greater conviction getting in, and it's then longs that need to be careful. So for now, the only real reason gold is likely to turn lower is if there's some sort of resolution in the Middle East, or the market moves into ignore mode, like it did with the Ukraine and Russia situation. So for now, we've got a big level, obviously, at 2,000, big psychological level. We've come up short of that and had a dip today, but again, the bounces are being bought into. So this rally may continue. Another break of 2,000 or test and break of 2,000 could mean we're going to leg much higher.
Yeah, very much so. I wholeheartedly agree with you there, mate. I think for me at the moment, the way I'm looking at gold is either long or flat. It's not something I would particularly want to be short of at the moment, given the headline risk, and also just given the momentum behind the move and the size of the flows behind the move. Really not something that I would be inclined to fight anytime soon. It is worth mentioning, I made this point on a couple of calls I was on this morning. We are in an environment where gold is moving in what we would typically say is the opposite direction to how it should. Treasuries are selling off pretty violently at the long end of the curve, and the dollar is rallying / remaining pretty resilient, which we'll get onto in a brief moment. So in a situation where we've got massive geopolitical risk, that textbook, throw it out the window. But as you rightly say, if the market moves into a point where it goes, we don't think this is going to escalate, we can ignore it, then you would expect those correlations to reassert themselves pretty rapidly and maybe pretty aggressively as well. So, caution required if you are long, but certainly I wouldn't be looking to get short of gold anytime soon.
Yeah, absolutely, mate. And you make a good point there. And, if you want to get in this one, then wait for that turn in the news, and then you're probably going to be doing the opposite of what we've seen, and it will come much sharply lower. But it's really all about the risk playing. And when those correlations break down, you need to know when that happens, because you need to know when an asset is trading one thing or another. This one's trading the Middle East and risk first and foremost above everything. Hence why all these correlations are broken down.
Absolutely. And you're never going to top tick it. You're never going to pick the top exactly. Even if you do the right thing, wait for confirmation, a couple of tests of that level, as you rightly saw in that yellow box there, you might get a fill $20 lower than the top, but you could be looking at $100, $200, $300 worth of downside. So, look at the bigger picture and zoom out rather than getting sort of hung up on picking the absolute top tick to the pip. Right. The dollar, we mentioned it a second ago. The dollar, this is the dollar index, but it pretty much goes for most of G10FX at the moment, has spent much of the last fortnight moving sideways, really, which, given I was out of the office last week, I wasn't particularly bothered about, because I came back and most of the charts looked pretty much no different to how I'd left them when I left the office a week before. I am surprised, I'll be honest, that the dollar hasn't seen more in the way of a rally driven from some haven demand. I think it's very much clear that, as you said, gold and also the Swissy seem to be what the market's preferring for that right now. If you look at the G10FX leaderboard since Israel and Gaza, that conflict began, the Swissy is up around 2-3% against the greenback. Everything else is lower. So resilience rather than rallying is how I would describe the dollar at the moment. And it's clear that the butt remains underpinned. Of course, geopolitical situation helping, higher long-end yields helping things along. And we've got this narrative of US economic outperformance bubbling along nicely as well, which should help to be reinforced by the GDP data this week. We had strong retail sales, industrial production, and of course, initial jobless claims coming back under 200,000 last week. So that narrative of economic outperformance remaining as solid as it has done in recent times. So although the dollar index ranging in a pretty tight 105.5 to 107, 107.20 range. Dips continue to be bought. I continue to be happy buying them. In fact, I'm happy to remain long of the dollar, looking for an eventual break north of that 107.20 mark. And I think I'd only be wrong from a technical standpoint if we saw a move back under the 50-day moving average, when I'd start to reassess things. But of course, headline risk is going to be a big driver of things here as well.
Yeah, I mean, that chart's pretty clear. We entered a period of consolidation. It stopped going up. That's the first conclusion you can take from this. Has it ended the trend, though? Definitely not. It's still pretty much a coin toss up here, whether it goes higher or lower, at least from a price action perspective. As I'm short the dollar, I hope it goes the other way. So we'll have to have a little wager on that one again, mate, after this week. But I think the dollar has hit a point of reflection, shall we say. It's got to think about what's it going to take for the dollar to be more stronger. There's going to be a more hawkish Fed, the economy heating up even more. And if that sort of thing happens, like we're talking about the GDP, then you're probably going to get the dollar going on its way. Or at the very least, are the rest of the economies going to do worse? Is Europe going to continue to go backwards? Is the UK, so on and so forth? So it doesn't necessarily have to be that the US is doing better for the dollar to do better. Everyone else could do worse, and the dollar remains the best of the bunch. So yeah, technically here, this is an inverse of what's happening in euro dollar as well. So I think, until you start to break down that trend, and that's why I use fib levels in this sort of thing, till we start hitting the 38.2 on pullbacks or the 50 fib, you've got to say the trend is still in play here until something breaks it one way or another.
Absolutely. Right, dollar. Oh my word! I've just seen your notes for dollar. I'm going to go and make myself a cup of tea, mate.
He's always moaning. He's always moaning. I don't know. I just like to be, fairly detailed, so our viewers know what they're talking about. So they're all kept in the light here. So yes, I'm going to talk about dollar yen, and I'm going to talk about how it's been a bit sort of stuck like glue. It's been stapled to this 150 level for most of October. Yes, we had the did they, didn't they intervention thing and a couple of sharp drops, but we keep coming back here. And this is some of the strangest price action I've seen, pretty much since the S&B had their cap in the Swissy. It's ignored the moves from US yields. It's ignored the moves in Japanese yields, safe haven moves in the yen, the US data, the Middle East affair. It seems that nothing is shaking this one at all. So buyers keep buying the dips, but there's someone up there at 150 that is selling those rallies. Now, there may be several scenarios in play here. Firstly, maybe there's some large official or unofficial offers up at 150. And unofficial means that the Ministry of Finance, Bank of Japan, are getting some of the big Japanese banks and whales to sell up the top here. They may also have the green light to buy those dollars back on dips, hence why the pair remains well supportive. There's also a huge amount of option interest here at the 150 level. And when I looked last week, there was nearly 9 billion expiring up until the end of the month, and nearly all of those were calls. So that means there's potentially a lot of hedging going on. The holders of those calls want the price above 150, but there's two sides to the trade, obviously, so there may be a lot of hedging going on around there. Also, I think that the dollar, and particularly dollar yen, is stuck between the Middle East risk and the US fundamental trade. As much as we you might think the dollar might go bid on the Middle East risk, the US have got, military and navy in the Mediterranean alongside the UK, China bringing some stuff in. So the Middle East risk isn't just, squeezed into Israel and Gaza. There's a bigger play happening around, all the bigger powers flexing their muscles, shall we say. So that might be impacting at least the dollar side of this trade. So how do we trade it? It's tough to be short for any length of time in this one because of the carry costs. But as we've seen from the intervention moment and then the spike we got last week, longs are spooked easily. And after that, decent dips follow. It's very tough to be long up here too because we're up against this brick wall. Really, the only way to trade it is, to try a long on a decent dip. But you have to know why it's dipping, or to go with a tight buy stop somewhere through sort of 150, 15, 20. Shorts, you can job off this 150 level if you like, but you need to be nimble taking profits, down around 149, 70, 80, because at the moment it's not giving you much more than that. So this is an interesting one to watch, but I think that the best way to play at the moment is just to watch it unless you're positioning for a break.
Very comprehensive, mate. I'm not sure I've got anything else to add, to be honest. I think you've covered every piece imaginable.
I've done my job then. See, if I make your life easier, that's what counts.
Exactly that. Right. Let's get on to our plays of the day. Right, I want to talk about the Swissy this week. I was talking about the Swissy earlier on and how it's proved relatively resilient in light of what's going on, broader dollar uptrend, but the Swissy is bucking that, particularly since the conflict began in the Middle East. it's very tough, I must say, and I'm not just saying this as a kind of get out of jail free card, but it is very tough to have a high degree of conviction over anything in the financial markets at the moment, given what's going on in the current risk environment and how many unexpected headlines we could get that just sort of throw a big curveball. So taking a bit of a safety first approach this week, and I'm going to go and seek out some shelter in Switzerland, which is where I was last week. So metaphorically seeking it out this week by being long the Swissy, short dollar Swiss. We're below the 200 and the 50-day moving averages, but of course, your technical levels don't mean particularly much given the current situation. More using this as just a hedge against uncertainty and against risk. If we get below the 89 figure, then we could get a little bit more momentum to the downside. I think if we get a move back above that 90 handle, then certainly I'd be looking to close out this position. But just seeking a little bit of shelter, a little bit of safety, a little bit of reassurance by getting some exposure to long Swissy this week, and remaining very, very attuned to incoming headlines as to the shifting sands of the geopolitical situation.
Yeah, very nice, mate. And I wish you well with that one. So we'll see see how we get on with that one next week. But
that was almost sincere.
Yeah, exactly. Well, I'm going to talk about your favourite subject now, which is the S&P. And there we go. The chart's changed now. I can talk about it. Whether it's we've got a bit of a make or break moment here at the 4,200 level. Even as we film this, we've been knocking around the level. It's had a dip below, just slightly down to 141.90. The question is going to be whether it's really going to break or hold on this move here. If it holds this move to 41.90 and gets back above 42, more so maybe 42, 14, 15, then longs will be favoured once again. If we get a move below that 41.90 level, and I think it needs to be seen with a retest and hold of 4,200, 4,205, that will be a strong signal for shorts. If that happens, I'd look to target the 61.8 fib down at the low 4100s. So again, I like to look both sides of a market. I don't like to pigeonhole myself into any one trade or another, particularly when you've got big levels like this. There's opportunities on both sides. Just got to watch that price action. So, go with longs sort of above 42, 14, 15. If we hold below that 41.90, 42 area, then its shorts are going to be the trade.
Well, very nice. We'll get Ryan off that fence he's sitting on at some point.
Oh, you're terrible, mate. You're terrible.
I was going to make a joke about splinters, but it's probably not appropriate. So we'll bring the show to an end there. Right. Thank you very much, as always, to my co-host, Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as well as he always does. Thank you for watching as well. If you've enjoyed the show, drop a like on the video. Leave a comment as well. Let us know how you're trading the markets and see if you can suggest any ways that I can use to convince Ryan to actually take a view at some point in the relatively near future. And all three of us will be back with another show this time next week. Thanks for watching. Goodbye for now.